Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
You know, there's a reason why I tell people, I tell you what is happening with rates, but I don't predict rates. No one should do that. Definitely not in the mortgage business. I am never going to tell you I know definitively what's going to happen with rates. Because this morning, or I should say Tuesday morning, if someone would put a gun to my head and said, you got to decide what's going to happen with rates today, I would have said they would have been up. And instead, we had, I think, the best day for the 10-year since June, late June. I think we saw a 9 bip drop, and on Tuesday, we saw about an 8 bip drop. So that's why I said I don't predict, tell you what rates are going to do. But welcome, everyone, to Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single day. And that's why I said we talk about what happened with rates yesterday. I can give you an idea of like, oh, I think this is what's going to be happening, but I will never make a bet on that. Sometimes like if everyone's saying it's going to be a bad jobs report or something, maybe you can do it. But we started off Tuesday. It was really Monday night. The Wall Street Journal releases a op-ed from Stanley Druckenmiller, very smart guy, well-known in the investment world. And, of course, he was a mentor to Scott Bessent. And I think Kevin Warsh as well. And he comes out with an op-ed basically criticizing what Scott Bessent's doing in the Treasury. I mean, not in totality, not everything, but talking about this bond buyback, saying, listen, let the bond market speak. If the bond market is telling you something, don't try and silence it. It'll tell you what's wrong. That's the whole beauty of the bond market, or markets in general. And so he comes out and just completely criticizes it. We saw the same thing from Citadel Securities. They also weren't on board. Just was a lot of negative reaction. And then, of course, last week, we saw the negative reaction to the plan put forward by Scott Bessent. So I said, man, I got a feeling, even though we saw a somewhat beneficial day on Monday, Tuesday's probably not going to be that good. And like I said, I was wrong. The 10-year fell to, I believe, the lowest level. Let me see if it's... lowest level since the beginning of August. The 5th of August, which I can proudly say I locked 2 people on the 5th of August. I remember that. There was something going on. I was like, man, we just saw a big drop. Let's lock. And rates have not fallen until, and they're still above that level. They were, at that point, they were at 4.61%, and right now we're at 4.62%. So we're still above that. And then unlike yesterday, we also saw a positive movement in the 30-year fixed. According to Mortgage News Daily, they had mortgage rates falling 4 basis points to 6.74%. So once again, a little divergence in that we're not seeing, on Monday it was complete, where we saw actually mortgage rates rise comparison to the 10-year. In this case, we did see a drop, but not as big. So we've essentially seen over a 10-point drop in the 10-year versus the 30-year, according to Mortgage News Daily, is only down 3 basis points. So kind of an interesting situation there. As we all know, of course, that spread between the 10-year and the 30-year does, expand and contract. This is clearly an expansion time. And then, so why is this going on? Well, everyone's pointing to oil. Oil prices are falling. I think because with what the United States is doing with Iran, there's no more. Obviously, they're still concerned about the Strait of Hormuz. I saw Iran and Oman are talking about setting up some sort of shipping lane. And I mean, they're clearly trying to do something. You know, how the U.S. is going to respond to that, we will see. But it seems like we're moving away from more of the sort of military conflict to now an economic conflict with the speech that we talked about yesterday that Scott Bessent gave on Monday, which is no doubt going to have an impact, but it's going to be a very different impact where it's kind of a slow bleed from the U.S.'s side. And, you know, from Iran's stance, they're like, hey, if we can outlast this, maybe that will be to our benefit. But it's no longer this sort of military. And they'll be spurts. I mean, we're definitely going to see. In fact, I think I saw a ship was attacked in the Strait. I believe I saw that. So we're still going to see some military conflict, but I think the markets are now reacting to a different phase of the war is what's happening. So oil prices have fallen. They're down now just over 7.5% for the first 2 trading days of this week. Brent crude's at $87, a little bit over $87, down from $94 at the close on Friday. So oil prices falling, that's just putting upward pressure on prices. That means potentially lower yields. So that's kind of what's going on. But it wasn't just that. We also had some economic data that could point to lower rates as well. For example, consumer confidence, that came out yesterday. Consumer confidence unexpectedly slipped. We're supposed to see a little bit of an increase. It actually slipped. Second lowest level this year, lowest level in 7 months. Consumer spending accounts for roughly 2/3 of the U.S. economy, which is why consumer confidence matters so much because of that reality. The Conference Board Consumer Confidence Index fell 0.8 points. It's not a huge move. 89.4, but under 90. It's the lowest reading since January, and economists were expecting a slight uptick, so kind of a double whammy there. And they broke it down. What's interesting is the Present Situation Index, which measures consumers' assessment of current business and labor market conditions, actually jumped. So people were feeling better about the current economy. That jumped 6.8 points to 121.2, which snapped 3 straight months of declines. But meanwhile, the Expectations Index, which measures short-term outlook for income businesses, labor conditions fell 5.8 points to 68.2. So the concern about the near-term future continues to be weighing on consumers. And so that means, for the most part, when consumers are concerned about the near term, they're okay with making everyday purchases, going to the grocery store, buying necessities, in some cases, even entertainment to some extent, but big purchases, so big appliances, buying a new car, buying a house, people are going to be less inclined to do that. And so that's why the Expectations Index falling is a problem. But it could be a good thing for rates. If people are feeling concerned, they're not spending, we see spending start to fall, especially on these big ticket items. You could see a reaction where they're saying, okay, we got to get things going in the economy, which could lead to lower rates. Now, it did break it down by consumers, like different demographics. Consumers under 35 remain the most optimistic, as they should be. When you're younger, should be more optimistic. Higher income households were also generally more confident than lower income groups. Politics continues to play a role, with confidence weakening among independents and Republicans, while Democrats became somewhat more optimistic. Maybe the midterms playing a role in that. That definitely could play a part, along with falling oil prices. Definitely is potential for lower rates, but a good day for the 10-year. And then kind of a good day for housing. The gold standard when it comes to home prices, the Case-Shiller Index, was up, which I think it was supposed to be up, but not as much as it was. The S&P Catality Case-Shiller U.S. National Home Price Index rose to 1.5% from 1 year earlier in June. Very delayed data. Up from 1.2% in May. That is the strongest annual gain since August of 2025. That was for the national index. And then the more closely watched 20-city composite actually had home price growth accelerating to 2.1%, bigger than economists were expecting, and the highest level since June 2025, so a year. Not bad data, especially if you're in Chicago, hottest market, with prices up almost 7% year over year. New York, 4.8%. Cleveland, 4.1%, while Seattle was the weakest market with prices falling 2%. So here is the rub. Here is the bad news. Homeowners are still losing ground to inflation. June marked the 13th consecutive month in which U.S. home prices declined in real terms because of 3.5% inflation. Even with the better than expected gain, we're still about 2 percentage points lower than the inflation rate, which means in real dollars, your home price is falling, unfortunately, but not nominal. And that's usually the metric that we use. Rebecca Kaufman, Associate Director at S&P Dow Jones Indices, said, while home prices continue to decline in real terms, lower inflation and firmer nominal home price growth in June did help slow that pace of erosion. So, yeah, I mean, it's not COVID era, and it's not even keeping pace with inflation. But I will point out that all the doomsayers on YouTube and Twitter and Facebook, who for 6 years have been calling for this great housing crash, is this it? It's not even in nominal dollars. Like, they have to use real dollars in order to make their argument, which if you remember in 2008, it wasn't real. It was nominal values of homes were falling. So yeah, where's this crash at? And what's crazy is, this is based off of stats with existing home sales falling, new home sales falling, all of that, and still yet some home price appreciation. So kind of interesting. And then before we go, I did want to talk about this. This is something that could potentially be a bigger problem. Not saying it is going to be, but it could be a bigger problem. And that is Canada announcing retaliatory tariffs after, of course, President Trump announced tariffs on Monday after talks broke down with our neighbor to the north. So the retaliation follows 50% U.S. tariffs on roughly 550 Canadian products, ranging from hockey sticks, honey, clothing, furniture, and cameras. President Trump escalated things by arguing that we could also see at the beginning of the year 50% tariff on anything auto-related coming into the United States. So Canada responded that beginning on September 8th, they would impose tariffs of 15, 25, and 50% on roughly 700 U.S. products. The most significant move will double tariffs on American steel and aluminum to 50%. And this stretches much further, covering products from household aluminum foil to railroad locomotives, steel bridges, as well as mirroring many of the same products that we're putting tariffs on Canada for, clothing, forestry products, tools, and electronics, and smartphones. And so why does this matter? Why is this potentially an issue? Well, there's no doubt that, sometimes we forget about Canada. But because of NAFTA, which then became the USMCA, we do a lot of trade with Canada, just like with Mexico. Mexico is our number one trading partner. And Canada is number two. Our number two trading partner. We have about $877 billion of trade, both in imports and exports, with China, which is relatively balanced. It's like a 20-some billion deficit. And that's, like I said, it's like 425 and 450, something like that. So it's like a $25 billion deficit. But here's the thing, like most countries who run a trade deficit with us, the item that they tend to be purchasing with those excess dollars is debt. In fact, Canada is the fifth largest holder of U.S. government debt with around $459 billion in Treasury holdings. And so that's why I said we already know that the U.S. is a little concerned about foreign countries dumping our debt, hence the yen currency. What do you call it? Basically, us trying to help them save and maintain the currency of the yen, because we were worried that Japan was going to have to sell off some of their treasuries in order to buy yen, and we didn't want them to do that because it was going to put upward pressure on debt yields, and so it was going to raise borrowing costs. So we didn't want them to do that. So everyone's aware that this is a concern for the U.S. And so Canada owns $450 billion in U.S. debt. And so they could dump that. Now, they obviously have a vested interest in holding on to it. I mean, U.S. debt, despite its issues that we've talked about, is still top dog. It's still as close to cash as you can get without being cash. It's still very liquid. It's still paying a pretty good, I mean, it's safe. And so Canada doesn't really want to do it, but I guess if they get to the point where they're like, you know what, we're just going to go after America and we're going to use everything that we can, let's start dumping some of these treasuries and push up their borrowing rates. And so, like I said, it's not an issue. I mean, it is an issue in that consumers are going to be hit by this. Producers are going to be hit by this. Canada is our second largest trading partner, so it's going to have an impact on our economy. That's just the reality of the situation. But it could also have an impact on rates because of Canada's debt holdings. So keep an eye on that. Nothing's happened yet, but just something to keep an eye on. All right, so it was a good day. Let's hope it continues. We got durable goods orders. And then what else do we have? Hold on. What's on the calendar? Where's my mouse? All right, we got durable goods order, second estimate GDP, PCE. All right, so that's we got a lot going on today. Inflation data, Q2 growth, durable goods orders. So we got a lot to get to on Thursday's show. But before then, you guys enjoy your Wednesday. We'll be back here Thursday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. Buy real estate and wait.